Welcome back. For the longest time, I was convinced accounting was just, I don't know, advanced math for people who really enjoy suffering. You picture these bean counters in some back room just making sure the numbers add up. Turns out, I was completely, totally wrong. And that right there, that's the whole thing. It's not about crunching numbers. It's about communication. See, every single business, I don't care if it's a corner donut shop or some global tech giant, is telling a story with its numbers. And if you can't speak the language, you can't read the story. You're basically just guessing. And trust me, in business, guessing is a very, very expensive mistake to make. All right, so here's the game plan. Think of it as our mission briefing. First, we're going to learn the language. Then we'll look at the key evidence, the snapshot versus the story. After that, we connect the clues. And by the end of this, trust me, we're going to crack the code that shows you what's really going on inside any company. Ready? Let's get into it. And look, calling it a language, that's not just some fancy metaphor. It's real. It has rules, syntax, and standards that everyone has to follow. It's kind of like a universal grammar for business, right? These rules are there to make sure that when a company tells its story, it's not just, well, making stuff up. There's a structure, and you've got to stick to it. And just like learning any language, it all boils down to one foundational rule, one core sentence structure that pretty much governs everything else. It's called the accounting equation. And believe me, it is the key to this entire system. Okay, so the first piece of evidence we're going to look at is something called the balance sheet. Now, the best way to think about this thing is as a single static photograph. It's a financial snapshot taken at one specific moment in time, showing you the exact state of the company. Yeah, think of it like a crime scene photo. Everything is just frozen, exactly as it was. And this right here, this is that foundational rule I was talking about. This is the core grammar. Assets equals liabilities plus equity. That's it. It just means everything a company owns, its assets, has to be claimed by someone. It's either claimed by creditors, people the company owes money to, that's liabilities, or it's claimed by the owners, that's equity. There's no third option. This equation is the unbreakable law that, in theory, keeps the story honest. All right, let's get our hands dirty. Let's look at a real evidence file. This is the balance sheet for a little company called Dachshund's Donuts. Now, I know, at first glance, it's just a wall of numbers, but once you know the language, you can see the whole picture. So let's break this thing down. It really is all about two sides of the same coin. So on one side, you've got the assets. This is all the valuable stuff the company has. It's cash, the donuts it hasn't sold yet, the big ovens it bakes them in. Then, on the other side, you have the claims against all that stuff. Who has a right to it? The bank that gave him a loan? Yep, that's a liability. The original people who put up the money? That's the equity. And this lays it out perfectly. Over here on the left, you see everything the company owns. Okay, so they're sitting on a decent chunk of cash, but whoa, they also have a lot of inventory. That's a lot of unsold donuts, right? Now look at the right. This tells us who has a claim to all that stuff. Looks like half is owed to creditors through loans, and the other half belongs to the owners. And did you notice? Both sides match, down to the penny. That's that unbreakable law I was talking about. It always balances. Okay, so the balance sheet is our snapshot, but a snapshot is just one moment. It doesn't tell you how we got there, does it? For that, we need the story, the narrative of what actually happened over a period of time. And that story is called the income statement. This isn't a photo, this is more like the witness testimony for the whole year. Let me just make this crystal clear, because it's important. Think of it like this. The balance sheet is a photo. It tells you exactly where things stood on, say, December 31st. The income statement? That's the video of the whole year. It tells you the story of how the company performed from January 1st all the way through to December 31st. So one shows you the position, the other shows you the performance. See the difference? So let's switch case files for a second. Let's look at the story for a place called Pete's Pizza. This income statement here, this tells us their whole story for the last year. Right at the top, you see their revenue. That's how much pizza they sold. That's the big, flashy headline number. But the real story, the part I find interesting, is how much they actually got to keep. And that, my friends, brings us to the most famous, and maybe most important, line in all of business, the bottom line. We're talking about net income. It's simple, really. It's just what you brought in, your revenues, minus all your costs and, well, all your excuses. That's your expenses. It's the cold, hard truth of whether you actually made any money. It's what's left after everyone else gets their piece of the pie. Okay, I'm going to be honest with you. This next part was the big aha moment for me. You've got these two separate documents, right? The snapshot and the story. And for the longest time, I thought they were totally independent. Nope, they are deeply, fundamentally connected. The story of what happened during the year directly changes the snapshot at the end of the year. Let me show you exactly how that works because this is cool. Because this is the critical question, isn't it? I mean, a company can have a ton of cash sitting there on its balance sheet. That snapshot can look fantastic. But what if their income statement shows they lost a mountain of money that year? Are they really healthy? You have to connect these clues to figure out if they're actually winning or if they're just treading water. So back to Pete's Pizza. After you subtract all the costs, the cheese, the dough, the labor, the rent, interest, taxes, all of it, Pete's Pizza was left with a net income of $156,000. That's their profit. That's the end of their story for the year. So what happens to that money? Where does it go? Does it just disappear? No, it flows directly back into the snapshot. That profit, that net income, it doesn't just vanish into thin air. It gets added to the owner's side of the balance sheet under a special line item called retained earnings. Just think of it as the company's accumulated savings, all the profits that have been plowed back into the business over time. This is the direct link. A profitable story on the income statement makes the company's position on the balance sheet stronger. They're two parts of the same whole. All right, deep breath. We're about to talk about the one thing that scares everyone away from accounting: debits and credits. I get it. I used to think it was just confusing jargon designed to make my head hurt. But it's not. It's actually the underlying mechanism, the secret syntax that makes sure the whole system works and that our main equation always, and I mean always, balances. The big idea here is something called double entry bookkeeping. And all it means is that for every single transaction, there isn't just one entry, there are two, a debit and a credit. It really is like Newton's third law, but for money. For every action, there's an equal and opposite reaction. And this two-sided system is exactly what forces the balance sheet to stay in balance, no matter what. Okay, so here's the secret code simplified. First things first, forget everything you think you know from your bank statement. In the world of accounting, debit and credit do not mean plus and minus. It's way easier to think of them as left and right. A debit just increases an asset account, which is on the left side of our equation. A credit increases a liability or equity account, which are on the right side. So let's say a company gets a $1,000 loan. Its cash, an asset, goes up by $1,000. That's a debit. At the very same time, its loans payable, a liability, also goes up by $1,000. That's a credit. One debit, one credit, and boom, the equation stays perfectly balanced. This chart right here, seriously, take a screenshot. This is the Rosetta Stone of accounting. It is the key to the entire code. Just look at it. Assets and expenses, they act the same. You increase them with a debit. Liabilities, equity, and revenues, they're the opposite team. You increase them with a credit. Once you really let that simple logic sink in, you can trace the effect of any business transaction. This is the engine that makes the whole language work. And honestly, that's the whole point of all this. This isn't about turning you into an accountant. It's about making you literate in the language of business. Because when you finally understand the relationship between that snapshot and the story, and you get the basic grammar of debits and credits, well, you can't be fooled anymore. You can actually read the evidence for yourself. So there you have it. You now have the key. You can look at a company's numbers and you can start to see what's really going on. Are they actually healthy or are they just faking it? The numbers, they don't lie. Not if you know how to read them. Thanks for tuning in, and make sure you subscribe for the next deep dive.